Hello again. I made a previous video where I showed the correlation between times of elevated volume and drawdowns in a stock, or at least in the SPY over the last year. So here I've got a 1-year chart, and I drew boxes around the drawdowns. The lower bar chart is the daily volume, and you can see that the times of high volume correspond to times of high volatility and very often a downward bias in the stock price. So here's a plot over the last 70 days. The SPY stock price is in red, daily volume is yellow, and smooth daily volume is blue. So there were two major drawdowns in this period, and you can notice that the volume was elevated during those times. So when you plot the daily volume versus the daily SPY returns, on the other hand, the trend isn't really that clear. You could fit a curve to this line, and you would get a mild negative correlation between volume and daily returns, but it wouldn't be a very high quality fit. You wouldn't want to hang your hat on it. So instead of plotting volume against the daily returns, let's plot the daily change in volume, or D-volume, versus the daily returns. Now we have a strong trend. So specifically, when the change in daily volume is positive, the stock typically falls. When D-volume is negative, the stock price typically rises. And the quality of the curve fit is obviously much better than the previous. So here's a plot of D-volume versus SPY over the last 70 days. So I plot the raw D-volume in yellow and a smooth version of that in blue. So the green line is a cutoff that distinguishes between falling D-volume, which is bullish, and rising D-volume, which is bearish. I've also plotted the SPY stock price in red. So how do I determine that cutoff? I have an optimization process, but in this case, the cutoff is very close to 0, which kind of makes sense. So the plot is pretty busy. So here I'll put some arrows marking where you get a signal from the D-volume attribute. So the green arrows mean bullish, the red arrows mean bearish. So a big question to ask is whether this D-volume indicator has any predictive power. So in other words, does the bearish signal happen before the drawdown starts? And does the bullish signal occur before the drawdown is finished? So for the two drawdowns in this sample set, you can see that the bearish indicator, at the onset of the bearish indicator, leads the start of the drawdown from between 5 to 8 days. So that's good. The bullish indicator seems to nail the start of the recovery pretty accurately. Maybe it's a day or two early. So here's about a year of data plotting SPY daily returns. And the daily returns are color-coded. So blue is days when the D-volume signal was bullish, and yellow is days where the D-volume signal was bearish. The SPY has been rising steadily in the past year, so most of the days are blue, which we expect. You can also see that most of the big drawdown days are yellow, which is also good. It means that the D-volume signal helps to keep you out of trouble. So here's a back test of the D-volume strategy. So yellow is a cumulative return of the SPY on days when the D-volume signal was bearish. It's pointed downward, which is good. Blue is a cumulative return on days when the signal was bullish, and it's pointing upward, which is good. So in this back test, the D-volume signal would have basically doubled our annual return over the SPY, which is green, while reducing the volatility. So obviously, back tests have to be taken with a grain of salt. And the real question is whether this D-volume signal will work in the future. I'm fairly sure that it will. It's a very simple indicator. It seems to be driven by market psychology. So unless market psychology changes, it should still work. But But if the SPY starts into a downward trend, and the D-volume signal spends most of its time as bearish, then you'll typically have most of your funds in cash. So the D-volume indicator can keep you out of trouble, but it's not going to find the best performing stock at any given time. That's up to you. So anyway, so how am I going to trade this? I'm still using the implied volatility slope indicator, and so far so good, but I really don't have enough track record to know if it's going to work in the future. I think I'll probably use this indicator in conjunction with the IV slope indicator, and not so much as a just kind of as a if both of the indicators are bullish, then it kind of gives me less risk aversion. If one is bearish, one is bullish, I'm kind of on the fence. If both are bearish, then I'll be out of the market. So anyway, would love to know what you think about this, good or bad, and we'll see you next time.